The S&P started the week 0.05 of a point below 2,600. It ended the week 16 points above 2,400, having come a whisker of touching 2,400 today. So quite the decline. Most of the declines in the past 3 days post FOMC statement, and especially post the press conference where Chairman Powell basically mentioned that they're going to continue on status quo with their expectations next year of monetary policy decisions. The market has obviously had that moment where you've had strong selling, extreme oversold conditions. I'm going to break all that down today, what that should tell us going forward. I'm also going to look for a trade idea in the sector that had been beaten up prior to this week and had stabilized before falling again. So let's go ahead and get started. Today is Friday, December the 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get straight to the S&P 500 with the market forecast indicator. So not too often that you can say you got a oversold cluster every single day of the week. We got 5 clusters in a row on the S&P 500 down here, which means intermediate posture has been, intermediate line's been below 20. It's now down to 5. All the short-term, both short-term indicators are down there. The near-term line on the near-term line has been down for, below 50 here, and really below. See, this is the first day below 50. As was above 50 right there, and then we had, for basically all 5 days, 6 days now below 50. So, first day not in the reversal zone. So that's obviously quite the oversold condition, as you can see on the weekly chart. That points out to the first weekly cluster that we've gotten in a long time, oversold weekly cluster. In fact, it's the first time the intermediate posture has even just been below 20 on the weekly chart for quite a while. You can see even in 2011, when we had that big decline in August on the credit downgrade, the intermediate line didn't get below 20 then. It didn't get below 20 in 2010 when QE ran out. We had to do QE2. So this is the first time the intermediate line's been below 20 since the March 2009 lows. So very, very significant pullback here. But you can also see too, from a long-term perspective, we're sitting at that 50% Fibonacci retracement. I'll show you that here in a second. Let's look at the Dow Jones first. Also 5 clusters all this week, 5 consecutive clusters. You'll notice that the NASDAQ composite has 4 in a row, so didn't quite get a cluster on that first day, but you got one on the last 4 days of the week. And then finally, the Russell 2000 has got 6 clusters in a row, coming off of a 7 cluster in about a 12-day range over here. So quite the oversold condition. In fact, you can see that the Russell 2000 since September the 25th, when it really started to decline here, we are down about 25% from when it really started to move lower. Excuse me, it started to move lower before the S&P 500 did. So oversold clusters out the wazoo here. You can, you've got it on the weekly chart for the Russell and the NASDAQ for 2 weeks now. Last week on both of those was very long. And keep in mind, this might not be the low point. Usually when you look at the weekly charts, we don't get a reversal without some kind of long lower shadow. In this case, we gapped down in 2015 and formed, it wasn't a long lower shadow because we didn't start the week higher. We started the week at the low. But you get the idea that when we get the major reversals, we usually have a long lower shadow, which means we hit a low point. Even here in February, we hit a low point where buyers are willing to step in, where it seems like it really is like the end of the world, and we haven't received that yet. We'll see if we don't get that here next week. I highly doubt we'll get too significant of a move next week with the holidays. It's usually very small moves over the holidays, but considering the moves we've had going into the holidays this year, we might break from norm according to that normal tradition, which means I might end up doing some market outlook videos next week. I'm scheduled not to unless something significant happens, as we are not holding classes all week at Market Scholars, but maybe I might if the ranges end up showing some significant patterns here. Now, before I take a look at some more interesting patterns here on some of these other charts, I want to remind you that that to let us know you want us to keep doing these videos, it's really easy clicks to give us feedback. Number one, click on this heart. That will take you to a new window where you can like tonight's Market Outlook tweet. Click on that like button. Two, you can click on this image. It takes you to your Facebook page. And there you can like tonight's Market Outlook Facebook post and share it with others you think might be interested in it. And then three, you can like it here on our blog as well. So 1, 2, 3 clicks. Again, we look at those to see how what your feedback is. That tells us. Of course, if you didn't like the video for whatever reason, you don't have to click anything. Also remember too, now again we have our holidays here. That's why the calendar's not out. But this is our calendars that we have scheduled. We actually have classes on the 2nd. It hasn't been updated yet. But our next classes will be my options inventory class that was scheduled for January the 2nd, and then finishing the week with Thursday's classes and Friday's classes as well. You can click this button to subscribe to our site, and when you're on our site you can participate in our Market Outlook forum for free to be able to talk about what we discuss in these videos throughout the day, between videos with other market scholars. Also, remember you can subscribe to our YouTube channel by mousing over our logo right here in the bottom right corner of your video. Then click that subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells us, again, that you want us to do the video again, and also tells us you like the video, you got something out of it today. In fact, I want to know what you did get out of it, if anything, by scrolling to the bottom and commenting down below. Join our daily Market Outlook email list with 330 stocks. On one of the watch lists that I'm sending out today, 180 on another. So it's going to be a long email, so make sure you subscribe to our email list to get those daily emails with those daily watch lists. And then finally, follow me on Twitter for more content like this throughout the day in between videos, and join our Market Outlook community that we created on Facebook. Alright, now let's get back to the charts here, and you can see we are close to now retracing half of what essentially took over 2.5 years to gain in a matter of what, 3 months, a quarter from this October down to now. That much of a decline. So we're almost to that 50% Fibonacci retracement level. I did mention, I tweeted this out earlier. We do have a close now below. This is the 1-year standard deviation. But look at the 5-year. We are now below the 5-year, two standard deviations below the 5-year linear regression trend line. That's significant. Look at the 10-year, and you see almost, you're basically right at the 2 standard deviation level for which 2417. Yeah, we closed a smidgen below it, a point below the 10-year, 2 standard deviations below the 10-year linear regression trend line. Again, that's pretty darn significant too. So needless to say, this has been a pullback, on a significant pullback, not just in the short term, but on a long-term basis. Now, it only took a few weeks, but still, on a long-term basis, we are extremely oversold. At least according to those indicators. You look at the 2 green arrows, or 3 green arrows, and I'm going to go ahead and break it out to the long-term chart, and you can see again here I'm going to take a look at the MACD down at the bottom and look at the current price relative to that 8-day exponential moving average. We're almost as low as we were back here in early October when we first had that big decline where it's. And this 2-day, you can see this has been more of it usually doesn't. Usually you get that initial surge early and then we start diverging. But you can see we're getting another big time surge. Here's what looked like in February when we pulled away from the green line as far as we have. You look to see how far we are away from that 30-day simple moving average. I'm going to change it from 8 to simple. And again, as far below it on an absolute basis we've been all year long. I have to go back out here to a longer term chart here, a 10-year chart, and you can see on an absolute basis again we are further below it than any of these lines. We are way below the 30-day simple moving average. On an average, on a relative basis, let me get my old calculator out here. You can see that we are at what the MACD is 200 and where are we at here? 246 points, 246.60 out of the current price level at 2416.58. That's 10%. So the MACD of how far away we are below the 30-day moving average, we are 10% below the 30-day moving average. We are currently, if you look at the 200-day moving average, which you don't see graphed in the chart, but we can still look at on the MACD here, we are currently that far away as well, and the MACD is at let's see here, it'd be at 337.07, 337.08. We'll do 08 divided by the current value of the S&P 500. We are now almost 14% below the 200-day moving average. Just for some context here, let's go back to what was previously one of the most bearish times that we've had is right here in 2011 when we had the credit downgrade, right? Let me zoom out a little bit. It was right 2011 right here. So had been one of the most bearish times again. This is how far away we are below the 200-day moving average. So at the worst in September of 09, the MACD was at 180.17. 180.17, and the value of the index on that day was at 1099.23. 1099.23. We were 16% away from the 200-day moving average then. So we are. This is pretty significant in terms of how extreme we've been. And again, when you take a look at how often we get such significant low points like this. The 1-year returns after the fact are double digits to 20% gains when you look for the closes below the second standard deviations. Also, another thing I tweeted out too, let's take a look at this next chart, which is this 4-week range. The 4-week range now has gone from 240 to 240 in the lows, 280 in the highs. So that's a big range. In fact, again, I tweeted this out. If I were to look at SPX here we go. So the range, the 4-week range for the S&P 500, that was at 2435. You can see eventually it got all the way down to 2408. So the range here for the S&P over the last 4 weeks has been almost 400 points, 391 points. That's out of 2800. That is 14% of its high. Now in August of 2011, if you look at that price channel here, let's get rid of all of these and just pull up price channel here. And we'll just do a 20 period price channel. I'm going to go on this 10-year chart and go back make it a daily chart. So these averages that we have here, and I need to get rid of that pane. 1 second here. There we go. So when you look at the last, the last times we've had significant declines, and actually we need to go to a 2-year daily chart. 1 second here. There we go. So we had a big move here in early 2018. Obviously, we had this big range in 2016, the big range in 2015. You can see those big ranges set the lows, right? When you get to those big extreme levels, those set those low points. When you get to the big extreme ranges, well, if you were to go back to 2000 and let's go to 10-year and go back to 2011. So over here, that's the biggest range that we've had. That was, according to my tweet here, an 18% range, 18.2% range when we hit that low in 2011. Earlier this year, we hit 11.8%. In 2016, we hit 12.9%. We hit 11.7% in late 2015. Remember, we are at 14% now, essentially. So, needless to say, the returns, the 1-year returns after those events, you can see it was 27% after 1 year later, after we hit that 18% range in August of 2011. 27% 1 year return. And the other returns off of the 2015 low was 16.5% 1 year later, and then of course 25%. But just keep in mind, 18%, that's almost a bear market according to the 20% definition in 4 weeks alone. That's how bad it got in August of 2011, and we're now at 14% in less than 4 weeks. Because remember, the high occurred here. The high occurred earlier, so it's not even 4 weeks. About 3 weeks. 14% move in 3 weeks from the high of the range. If you take a look at the volume and the range, of course the volume was significant here. And the ATR is now really starting to bump up. So there's a third consecutive day of 1.5 times the average, 250 million. When you look at the weekly range, you can see the spike in volume, the biggest week of volume that we've had since February the 5th, bigger than all of these that we've had earlier. You can see again, if I were to go at 1 billion shares trading hands here. If you were to go over here, we got over 1 billion in January of 2016. Of course, here in August of 2015 is when things really hit the fan that year. But you can see kind of similar numbers to where we're at right now. And then, of course, back in December of 2014, we had 1.2 billion. And then in October of 2014, we hit 1.3 billion, and those are all extremes. In fact, if you take a look at from a 3 standard deviation level here, this is 2 consecutive days of over 3 standard deviations of volume. That's what that line here, this black line, is telling us. Now, when you look at the volatility index, we almost closed with another surge up above this 115% mark. Came right below it. You can see we closed right at it, closing at the highest level for the VIX, finally closing above 30 here. Again, we don't get reversals without long upper shadows, so we need a long upper shadow before we feel confident about any kind of reversal at all in the markets. And if you look at a weekly chart, you can see we're not getting that reversal this week. So even in February, that week we did get a big long upper shadow, and you can see some of these other weeks, but not this week. So you need to have a week where we do. Now you notice when you do get when we close the week at the high for volatility, like we have, this would be in June of 16. This would be October of 2016. Again, both closing at extreme levels, right? That's what this says down here. And of course, February there, and March 19 of 2018. Every time we close at the low point, then we finish the week. We came back down the next week. This would be August of 2015. Sometimes you get the long upper shadows. You might fill in that range a little bit here before you finally come down. But when you close at the week, it's almost an immediate pullback. So now, granted, next week is a 3.5 day week. So we might not have a lot of volatility simply because of the holiday. But again, since we had such an abnormal move going into the holiday, I wouldn't expect a normal holiday move next week. It'll definitely be something we want to pay attention to more than any other holiday week, at least in recent history. So to summarize, this week's move, this week's move, it's very, very extreme. We more than likely will get pretty decent 1 year returns from here, based on what we've seen in some of these patterns, with where the volatility is, with the ranges that we're seeing, with how far, being below the 5 and 10 year linear regression trend lines. Now, that doesn't mean that we'll have a good 1 week return or even a good 1 month return from here. And in fact, I do believe that we don't get a reversal until we get a long lower shadow, which means on a weekly chart and even on the monthly chart, but especially on a weekly chart, which means we'll probably start a week really bearish to the point where it'll be a capitulation type move on an intraday basis, but especially on an intra-week basis, then that will mark the low. And you can see we're still a smidgen above the 50% Fibonacci retracement. So that could come next week. It might, more than likely, will probably come once we get full participation in the markets after the holidays in early January. But then we have buying opportunities now and a lot of issues that you haven't had in a long time that we probably won't have again for a long time. But then as the markets bounce, we have an area of watching to see at 2,600 if it fails that return move, because then that's when the bear market starts, right? That's when we're stuck now at new highs and new lows, below 200-day moving averages, and we could be in that kind of a mess for months. So that's a key level to watch if and when we do start to get that reversal. Again, according to some of these numbers that you see in terms of one-year returns, with such extreme, we wouldn't expect that to happen, but that doesn't mean it can't. So as we head into a new week in the next couple of weeks, watch for that long lower shadow to develop. That will be your sign, even on a daily chart. And that will be your sign that we could start to reverse, especially even on the volatility charts too, those long upper shadows. Then we'll watch to see how far and how fast we go with 2,600, a very key level to the upside in the early part of next month, if not in beginning maybe at end of January. And then that will be our key level to watch. So that's my summary and market outlook for tonight. What do you think? Do you agree with that? Do you disagree? Let me know by clicking that poll that's popping out in the top right corner of your screen. If you click disagree there, scroll to the bottom. Let me know what you're seeing that maybe suggests something different. Either maybe you're more bullish than me, or you think that there might be a significant a large amount of upside left to the downside before we turn around. Let me know what you're seeing that would suggest that, and you can share that with other market scholars as well. All right, now let's take a look at what's driving the price action today. This is the last 2 weeks. Of course, here's the today in small cap stocks, growth stocks, mid caps, large caps, international developed, emerging markets. Where's the emerging markets? Right here. Not so bad. So they're emerging markets continuing their outperformance here. Remember that they did so poorly all year long, and they're starting to show some relative performance. Value holding up a little bit better, but still down 1.5%. Dividend stocks also down, but not holding up better. High yield down 0.5%. Gold down a little bit. There's investment grade hardly down at all, outpacing, and long-term bonds down a smidge, with short-term bonds at $1. So that's truly a safe haven right there. Mortgage-backed securities, municipal bonds up a smidge as well. So you can kind of see. This was risk-off day today. Big time capitulation type of a move. With how big the sell-off was after being up early in the day and then finishing much lower in the S&P 500. So this is the last 2 weeks, and you can see over the last 2 weeks, small caps and crude oil is down 13.5%. Small cap stocks down 11%. If I were to change this now, again going back to October the 3rd, the high point that we had, you can see crude oil is down 40%. 40%. You think the stock market's down a lot. Crude oil down 40%. Now remember, the S&P's down 17%. That's a pretty significant decline, obviously. But we've also seen, some of those numbers that I've shown you before from the foreign markets. You can see here, going to the 12 major economies, clusters all around. Canada getting clusters, France getting clusters, UK, Germany, Japan, Italy, all getting clusters. Brazil even with a pullback. But look at these red numbers are all year-to-date declines. So we're down 10% on the S&P 500 year-to-date, obviously 17% from the October high. But remember, all these were already down heading into this period of time. And so you're looking at, the Japan's down 17.5% year-to-date. Germany's down 25%. Year-to-date. UK is down 20%, France is down 17%, China 18%. These are some pretty big numbers. Canada now down 21%. It was actually holding up really well until this last little drop here. And then South Korea down 23%, Italy down 22%. So these are pretty big numbers. The ones that aren't as big are Russia and India, only down 13%, and then Brazil down 10%, despite really big volatility to the upside early and then way to the downside, down 27% early before bouncing, and then of course the S&P, which was up about 10% year to date or 8% year to date at its peak before this decline that it's had. So it kind of puts this move in perspective. As big of a move as this was, these other markets have already shown this type of decline and have since done it again and showing double the losses. But emerging markets are starting to show a little bit of a rebound. And you see that in India here, you see that in Brazil showing some outperformance. You expect China has been basing, the S&P is way down below its lows from early October. China's not. So it's the focus before is on this trade war. It doesn't appear that this is trade war related because in the past these other countries have been plagued by those trade war headlines, but they're not being plagued right now. Japan, some of these developed markets are, but not necessarily the emerging markets like Korea and China and India. These areas are not impacted at all during this with this current decline. Interestingly, when you look at the rate hike odds for next year, you remember Chairman Powell said that their estimates were for two rate hikes in 2019. If you notice, we now have odds for 2 rate cuts in 2019. Now, granted, 0.1% chance that we'll get that second rate cut. So, very, very low odds. But, these columns haven't appeared for multiple years. They're just now starting to show up. And, of course, the odds for those 2 rate hikes or more in 2019 are just 10%. So, that's down from 16% a week ago. So the market doesn't believe what the Fed is selling. And you can see a month ago, the odds for 2 rate hikes in 2019 were 32%. So we had actually pretty decent odds. So they're dropping pretty sharply, even if the odds for 1 rate hike are still pretty flat. That hasn't changed. You get at least 1. It's just that second one, pretty good chance we're not going to get it. And you can see if I go to March 2009, getting the 1, you can see the odds of it being in March, 15% odds that we'll get a rate hike in March, and that's down from 20, down from 30 a week ago, so cut in half. So most likely we're not going to get a rate hike again for a while. If you look at June, the odds are only 30% that we'll get one in June. So we're not getting very high odds either. Usually that will be up around 40, if not higher, as we approach and as we get closer to March now that we're past the December meeting, it should be getting closer to, moving its way towards 60. So obviously not the case, and you can see even that number's down from being 40% a month ago. So again, the market's not buying what the Fed's selling in terms of the need. I'm not seeing the need. Now, keep this in mind. This is the financial stress index. This has been brought up, and it's been rising. And the fact that it's been rising is what's been brought up. That you can see well off of its lows that we had in December of 2017, when there wasn't very much stress at all, and even here, well off of its lows from end of September, beginning of October. But put this move into context, right? Those numbers on the left are negative. If you go all the way back, you can see when we hit recessions, which is the shaded area, this index is up at 1, and you can see it was over here too before that recession, 2000, 2002. So yeah, it's we're not even to 0, much less up to 1 to worry about. And remember, the stock market peaked in October of 2007. So this financial stress index peaked before the stock market peaked. Same thing in the S&P 500. It peaked over here in September. We were up at 1 before the stock market peak, coming off of really low positive numbers in 98 and then again in 99. So we're not even the low positive numbers here, much less anywhere close to levels that would signal recession, these from the financial sector. So keep that in mind again. When we see these numbers, and GDP did come out today. Here's the GDP number Here's GDP growth on a year-over-year basis here, real GDP growth. So taking into account the inflation, they're adjusted for inflation. You can see that it's continuing to rise from Q1 of 2016 to now. That's a year-over-year growth rate for GDP. Now, is it going to continue to rise? Who knows, right? This is pretty high levels. We peaked here in 2010, coming off of significant lows. So there's a big low point there to grow from. We peaked in 2014 at the end of the QE3, right? We had a nice good run of GDP growth fueled by QE3. This has been fueled by fiscal stimulus, and we're getting close to these levels. But we haven't started to come down yet. So the market's pricing in, with a 17% decline in this quarter, is pricing in some real significant, a lot similar to something like this. In fact, this is the worst month and the worst quarter that we've had in the market since that fourth quarter of 2008, when things were fell off a cliff and were dire. We were already in a bear market before that happened. We haven't been in the bear market until this quarter. So it's a much, much different environment now than it was then, which suggests that a lot of the selling seems to have piled on itself and is way overblown, especially if any of it's headline driven in terms of government shutdowns, because there's a tweet from Ryan Dietrich that mentioned the market's gone up every time there has been government shutdown. So that hasn't actually been an issue, usually, and they usually get resolved eventually pretty easily. So, it seems like a lot of this selling has been very headline driven, whether it's trade wars, whether it's tariffs, whether it's monetary policy. So somebody posted the Fed's minutes, the Fed statements about the monetary policy, about the economy, and their policy from 2007, right before they started cutting rates. So they went from a neutral, because remember they were raising rates in 06. They stopped raising rates in 06. So they were neutral on raising rates, and then all of a sudden they started cutting. But their statements before they cut showed the expectations for a very strong economy. And now obviously things were much different in 2007 than what they are now. But this shows that the Fed can switch its policies if and when they see the need fit. So, a lot of this, again, selling, if it is in fact due to monetary policy statements, very well could be way, way, way overblown. All right, let's take a look at the sector selector has been updated here, and you can see not a whole lot of change from one week to the next. The only change is materials went up as ranking and financials went down. Again, this is our Brandon's proprietary tool that he's created to rank our sectors, and you can see since October, the early part of October, which you see on the left-hand part of this chart, utilities were up and have been the number one or number two sector for this whole time. You see real estate started the month of October down, and it's been up higher, and of course staples is up, and you can see other sectors like energy down. Healthcare was a top sector. It's still in the top 5, so it's been holding up pretty well as well. Communication services also holding up, whereas technology and discretionary. Technology was strong at the end of September, as was industrials, and those two crossed below these safe haven areas. Industrials crossed below there in early October. Technology did too as well. That kind of third week there. That's when they crossed staples, and then they both crossed real estate the very next week. And they've been below. Again, these three that you see at the top are typically safe haven areas. The ones you see at the bottom, materials, industrials, and energy, are all dollar-related sectors, dollar-sensitive sectors. Discretionary technology, communication services, they're obviously more risk. They're more associated with risk appetite. But also tend to outperform these others depending on what the dollar does. So it kind of gives us an idea, when they shift places, one way or the other, kind of gives us an idea of which way the market's heading. And we saw, you see that going there. Now you notice on a year-to-date basis, you can see S&P is down 10%. Utilities is still up 3% for the year. So utility is still showing a gain. Healthcare just barely got to a loss this week, is only down 1%. Real estate also showing a loss this week, was up slight positive, but now is down 5%. Your biggest losers on the year are energy and materials, along with communication services here. But energy, materials, communication services got a late start, right? That's why it's down so much. But these two have been hit by that strong dollar, and financials with the yield spread falling, and industrials with that strong dollar too. They've been your worst performers all year long. And then your safe haven assets, and then technology and discretionary, which were so bullish heading into that high point in October, now showing small losses, 8%, 8.5%, 6.5% down for the year. Staples is really getting hit hard too. So it was holding up pretty well until this last stretch in December. And you can see it's gone from a 2% loss to an 11% loss, just like that. So here is the performance since that October high point. Utility is still holding up despite this pullback here this week, and utility is still showing a gain since that October high, where the S&P is down at 17%. You can see energy, you can also see technology and industrials all 20% or lower. A few others approaching 20%. Healthcare only down 13%. Staples down less than half of what the broad market is, and real estate holding up too. But you can see, as of a week ago, they were all three positive from that October high, and they're really struggling from this peak on 12/13. If you look at 12/13, that's pretty much when everything started to fall. There's 12/13 right there, and here let's just go to like an hour, a couple hours chart here. There's the peak in the market on 12/13. Since then, you can see the market's down almost 10%, and everything's down. Even utilities, real estate, materials, financials, industrials, all beating the market. Technology, discretionary, communication services lagging behind big, along with energy. Remember, crude oil really struggling. So you can see on any kind of bounce that we may get, if and when it occurs, it's probably going to be driven in this area here, especially with crude oil. If and when crude oil itself makes any kind of recovery, like I said, down 40% for the year, or 40% here from this mark, from 74 at the beginning of October to now 45. That is significant decline. You can see coming up off of that low point and then falling through, we basically have reached the 262% Fibonacci retracement level, which are these old lows. So that's a significant drop, and there's some major support here. If I were to go back even further, I'm going to go look at it on a weekly basis. So you can kind of see what the chart looks like. You had that inverted head and shoulders here, and that we rallied off of, and now we're coming back down to retest that area in this 45. So there's some Fibonacci support in that area, and then of course bonds. There's your 10-year yield starting to pull back towards Fibonacci support as well. Again, off of that, this would be the 2017 low point that it's had. If you look at TLT, and let's just look at it straight up chart of TLT here. TLT again. A little bit of a breakout in long-term bonds, breaking up above the 200-day moving average. MACD rising close to crossing above zero itself. So really good bullish week for this is the longest term bonds that would be associated with more of the 30-year yield, which after this breakout above 3.2% has failed, and now we're back below that breakout area, back towards 3%. TNX, take a closer look at that, back down to below 2.8% with this week's drop. So big declines below its 200-day moving average, with the MACD coming down from this divergence, bearish divergence there. The real estate sector had been holding up pretty well, especially with the drop in yields. It really suffered for most of this year. This is Pulte Group, gotten a lot of clusters coming up off of its earnings, getting a low of $20 for the year, coming off a high of 35. So big, $15 drop, almost a 50% loss in this particular stock on a year-to-date basis. and then it rallied. And it kind of hit some Fibonacci resistance here. Was trying to figure out this a new trend, but closing below some lows here today. Bearish posture. You look at the 3 green arrow chart for Pulte. You can see how we've crossed below. I mean, we've been converging. We crossed below the 30-day moving average. There's the MACD's crossing zero, stochastics bouncing out, moving a big, strong spike in volume. You know, the sideways trend with a spike in volume to the downside now, 3 red arrows. You know, that's a bearish signal. Of course, you look at other indicators. You look at the Bollinger Band breaking into the lower half of the chart is a negative sign there. You look at the DMI. Look at these other DMI indicators as well with it. And you pull up PHM, and you can see the negative. And they were both below 20, but now your negative's rising, rising up above 20 with some bearish signs here. So potential for a bearish move to the downside in this, especially if we get that long lower shadow before things turn around. We might be able to get up to, you know, if we look at selling, you know, the 26 and buying the 28 and trying to get that 47-cent credit on a $2 Y, that's a 30% return on risk. You know, if we can get, you notice that $48 is our max gain. If we can get 24 of it, see how fast you can get the first 24, a lot slower to get the other 24. So if we can get the 24 of it down to this $24 area, which is right, you know, in here, just to move down to that, if we can hit that while the market's kind of figuring out its gloomiest low point, then there's a way for us to take advantage of the bearishness in the sector that, at least before the last little sideways move here, has been a really beaten up area in the markets with the higher mortgage rates and lower sales and the lower home builder sentiment that we recently saw. Really low. So we'll see if we can take advantage of that with a quick and easy bearish trade during this bearish posture. So that does us for tonight. Again, I want to hear from you now. Click that link that's popping out in the top right corner of your screen. That will take you to our forums. You can post there any questions or comments you have for me or on anything I talked about in tonight's video, or any questions or comments on anything I didn't cover. You can post there and be able to continue the conversation with other market scholars before we meet together again on Monday. Again, thank you very much. Have a great rest of your weekend, everybody. Hopefully you're not too slammed on that last Saturday before Christmas and your last minute shopping. I hope you all enjoy this weekend and the holiday season for that matter with friends and family. Thank you for watching these videos day in and day out, commenting and hitting the likes buttons. That's a really big deal to us, and we appreciate that. We've had a really interesting 2018, and you are a big part of that. We appreciate you. We appreciate you making this possible for us to start this new company and be able to share what we love with you. So thanks again. Have a great night. Have a great rest of your weekend, and we'll see you all next time.